we haven't seen retail or large volume of investors in this sector yet. And I think, again, it's because of like show me the money kind of thing. It's always been like kind of 4 steps forward, 3 steps back. And, and there have been reasons why it was 4 steps forward and then, all the way back. But now I think we're at the point where there is no back. The spot price is going to remain high. I think that once we work through this chop from the rebalancing, I think that the Kazatomprom conference call on February 1st is going to give us more information on what's going on with their production issues. I think they have more issues than what they're letting on. They blamed it on sulfuric acid, but I think it's more than that.
Hey guys, Capital Cosm here. Before we start this video, I just want to let you know that I believe that we are on the cusp of a major uranium bull market. Now, these things don't happen every other week. The last uranium bull market peaked in 2007, the one before that in 1978. So when these things happen, you've got to take advantage of it. And how explosive are they? Well, you've all heard the stories. Uranium skyrocketing from $10 to $20, all the way up to $150 in these uranium bull markets. Where will it go this time around? Well, we don't know. We'll see. But you've got to take advantage of the opportunity. What better way to do that than to leverage Justin Hune's Uranium Insider newsletter? You get access to his monthly newsletters, his webinars, his stock picks, his portfolio, all of that stuff. You get access to guests that you may not see on YouTube. You get access to having them ask questions that you may not see anywhere else. So I highly recommend, if you're going to take part in this uranium bull market, you check out Uranium Insider. Link is down in the description box below. Be sure to click the link. There's quarterly plans, there's annual plans. So if you're kind of tepid, you're kind of hesitant, you could always go with the quarterly plan. Kind of test things out, sample things out, see if you like it or not. But the way I see it, guys, you've got to pick the right stocks. A lot of these uranium companies are not going to make it to the other side. Now, and Justin Hune's uranium portfolio has outperformed the likes of URA by a significant margin. Since 2019, it's up 5x from where it started. So click the link down below and we'll get started right now on the video. Thanks, guys. Hello and welcome to Capital Cosm, everybody. Today I have another special returning guest on the show. It is Mr. Terry Papineau. Always a pleasure to have you on, Terry.
Hey, it's my pleasure to be here, and cheers from beautiful Turks and Caicos.
Cheers. Well, Mr. 100% uranium is in the house here. Uranium has been making some really bold, big moves. We're going to talk about uranium throughout the entire video today. But before we get started, nothing on this video is to be taken as financial advice. Neither Terry nor I are financial advisors, so please do your own due diligence. Terry, let's go ahead and just jump right into it. Uranium is sitting at $106. The equities have moved up, but not as fast as the metal itself. What's your general prognosis of the uranium market at the moment?
Well, what my general prognosis is that there's a reason why, we saw the price of uranium double in 2023. It started in January 2023 at about $50 a pound, and it ended close to $100 a pound. And here we are now in the third week of January, and it's sitting at $106 a pound on the spot market. And so that's, there's a reason why the price is going up, why it doubled. There's a reason why uranium is the best performing resource or metal of 2023. And I think that it will also be the best performing commodity in 2024. The setup is absolutely brilliant. Keep saying this, people are gonna, are tired of hearing me say this, especially because the uranium sector seems to be, you take 3 steps forward and 2 steps back, and sometimes it's 4 steps back, and then you got to wait and be very patient, and it keeps going again. But I mean, since I've been in this sector I started doing my research in 2016. And the fundamentals were great in 2016. It's just a simple supply demand setup. There's just not enough supply for the growing demand. but the the setup has just completely blossomed, completely, it's just so much better than when I first started. So which is the reason why we're seeing the price appreciate. In 2017, the price of uranium was sitting at $18 a pound, so it's already gone a long way, and it's going to keep going quite a bit higher in my humble opinion. And we've had some good periods of time since 2017 where the equities had good runs in them, and then big, large pullbacks. And I think that's exhausted a lot of people. I think it's affected sentiment. Sentiment is kind of low in the sector right now. We had a great January with the rise in the spot price. We had a great run in the equities, and there's been a pullback in the past couple of weeks, at least at the last 10 days. And now there's also going to be some movement in the equities because URA, one of the ETFs, needs to rebalance. So some names will be sold off. Some names will be, some positions will be added to, and some new names will be added. So, I mean, there's a lot of movement and there's a lot of things happening, and the fundamentals have just improved tremendously. And it's very promising and difficult to see how 2024 will not be a very important year for uranium and uranium equities.
Yeah. So as you've alluded to, the equities have kind of lagged a little bit behind the spot price. Do you think this implies that the spot price might be a little overheated at the moment? What do you think?
No, I don't think it does at all. So we could talk about the spot price and just uranium itself, but with regards to equities, I think I think it's a question of, this thing has been taking quite a long time to play out. What I mean by that is, if like when I got into the sector, I was telling people, and I, in my mind, thought it was a 3 to 5 year play. But obviously it's taken more time than that, and I was hoping that it would play out faster than that. But so, and in that period of time, like I said, it's always been like 3 steps forward, two back, three back, four back, and then, so what's happened is I think you've got kind of different categories of people in this sector. You have people like myself, Justin Hume, some of the first people, Malcolm Rawlingson, John Quakes, Andrew Weekly, Trader Ferg, um, those types of people who've been in this thing for quite a long time. And we truly understand the fundamentals. We know that, the theory back then has really played out exactly like we figured it would. And now the fundamentals are even better. So I think you've got your core group of people that have been really did their homework, know what's going on here, and have held strong through thick and thin. And then I think you've got tourists that come in, once in a while. I think you've got traders that come in and then profit from the volatility. And then I think you've got people that came in at exactly the wrong time, that got completely burnt and are just fed up with the theory or the sector. And so when you see a move, like big moves like we've seen in the spot price in December and January, and then when you see the corresponding equities move, people know that something's going to happen in this sector. People are watching this sector. And when when the spot price starts to run, then people start to jump into the equities, and they go, okay, I better pull out, because we know we've seen this story before. It's going to go up, and then boom, there's going to be a period when everything, this house of brick was going to fall down. However, this time is different. I truly believe that this time is different. We had a really, really big run in 2021 when Uranium Participation Corp turned into the Sprott Physical Uranium Trust. and the Sprott Physical Uranium Trust started buying uranium. They drove the price of uranium from about $30 a pound to $60 a pound in about 3 to 4 months. And in that period of time, the equities did 3, 4, 5x, which was a lot of fun. And some people came in at that point in time, and then we had a large pullback, and people were really disappointed with that. Now, the situation now, I believe, is quite different. Back then, what drove the price of the spot price up was Sput coming into the market and raising cash, buying uranium, sequestering it, and that would drive the price up. I think that the utilities and the producers were not quite in the market as at that period of time, whereas now, what we saw in December and January, with the rise of the spot price, was really not created by financial players. It was created more by either producers, I believe more producers and possibly some utilities, grabbing some of that available inventory at those prices while it was still available, because they see the writings on the wall. And the situation now, the setup now is with both Cameco and Kazatomprom, with regards to they'll need to be making purchases in the spot market. And last year we had 160 million pounds that was written in term contracts, and we know that this year more term contracts need to be signed. There's really now a situation where it's not the financial players moving the price up. It's the players in the industry. It's the producers and the utilities, and it's going to get. I think it's going to get a little bit more tense, and I think it's going to drive the price of uranium much higher. And there's a lot more to be said on that if you wanted to discuss the news that came out of Cameco and the news that came out of Kazatomprom. I don't know if you want to touch on that.
Yeah, let's go ahead and dive right into it. What do you
Okay.
make of the supposed production cuts from Kazatomprom and the news from Cameco as well?
Yeah, that's so exactly. The thesis here in this sector is it's a supply demand situation. It's that simple. And what's really unique about this commodity is that no matter what the price is going to be, the utilities have to buy it. They're going to buy it. And normally when you see a situation where the price of the unit or the commodity goes up, well, sometimes demand goes away. Well, here demand will not go away.
I think like a $200 move in the spot price is equivalent to about a 1 cent change in like electricity prices.
Yeah, so like the billions of dollars that utilities spent to build these nuclear reactors, I mean, they're not going to turn those off because they need to pay more for. They need to keep them operating. Number one, because they need that reactor to generate the electricity to meet the electricity demand. And number two, they want to make money. They want to be able to sell electricity to make money, make the money back that they spent to build the thing. So the demand is very secure. We know that demand is sitting at about 185 million pounds right now per year, and the supply is about 155 million pounds a year. So it's a strict supply demand fundamental where there's not enough supply to meet demand. Okay, so what's also really interesting is the fact that, like I said, demand, there's hardly no risk to demand. Like, they need to keep those reactors running no matter what. And, so they're going to keep buying this stuff. So demand is not only is it secure, it's rising. So it's growing because more and more countries are committing to nuclear now. There's more reactors that are going to be built. There's the advent of new small modular reactors coming online in the upcoming years. So demand is strong and growing and secure. But the issue is supply. So you've got all kinds of geopolitical risk here. You're in a commodity that is complicated, such as uranium, where it's not easy to build mines, to permit these mines, to find the manpower, blah, 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 blah. So, and the supply of this stuff is really, there's two main companies that produce the majority of the supply, and those two companies are Kazatomprom and Cameco. And so what's happened in the last 6 months is that Cameco has announced that they won't be able to meet their production guidance for 2023, possibly 2024. We're going to know more about this at their conference call on February 8th. So, so there's some risk to supply right there. And at the same time, well, not the same time, but last week, Kazatomprom announced that they won't be able to meet their projected production for 2024 and 2025, which again is further risk to supply. They're the world's biggest producer of uranium. So what does that mean? Well, it means that, if you were counting on, if the demand for this year is 185 million pounds and you're counting on 155 million pounds being produced, well, now it might only be 150 million pounds being produced. We're not sure yet. So there's going to be even fewer supply. And and all that is happening at a very, very interesting time, a very interesting point in time, because what's been happening is both Kazatomprom and Cameco have legacy contracts. What I mean by that is that contracts that were written in the past, and you have to understand that the conditions when those contracts were written are not the same conditions as today. So, like if you're a producer today and a utility comes to see you and they want pounds, while you're in the driver's seat, you can basically say it's going to be this, take it or leave it. And
$70 was the incentive price back in 2020. Like that's what I heard back in 2020.
Yeah, versus what it was like when those legacy contracts were written. But let me just give you an example of that. South Korea came out with an RFP last year, and usually those RFPs get filled with Korea. They're a good client, but they're very, they want it to be at this price and blah, blah, blah. And they don't like people screwing around with those numbers. And that's what they want. And that's what they were always able to obtain because there was a lot of uranium around and the price was cheap. Well, they had no one that bid on their RFP. So at the terms that they had set. So what I'm saying is the conditions today where contracts will be signed were not the same as 4, 5, 6 years ago, where the utilities were in the driver's seat. And the reason why that's important is because two things. Number one, that you might want to get into is number one, both Kazatomprom and Cameco may be oversold. So, which means that they might, that's what people are talking about right now, is that they might have to, like, let's say
they're overcommitted.
Good example, Cameco can produce, their share production is about 26 million pounds per year. But let's say this year they signed contracts where they need to deliver let's say they oversold and they need to deliver 27 million pounds. Okay. Because of the conditions that existed in those legacy contracts, that 1 million pound, that's more than what they can produce. So they could produce the stuff at, I'm just going to throw out a number, let's say $30 a pound. Okay. And if the average selling price in those legacy contracts is $40 a pound, well, they're making money on that 26 million pounds. But that extra million pounds that they won't be able to produce, they need to deliver those pounds. And so they need to find that material, that extra million pounds, they need to find it. And if they sold that million pounds for an average price of $50 or $40, let's say 50, well, they need to go out in the market and they need to find that million pounds. And if they need to buy it in the spot market, well, then they'll be paying $106 a pound for it. So on that extra million pounds that they can't produce themselves, they could actually be in a situation where they're losing money on that 1 million pounds that they're selling. Now, Cameco has other ways of obtaining pounds. They've got joint in the past, and they can they have different ways to obtain material, but what I'm trying to show here is that what happened in December and January, the price going up, might be the Cameco's and the Kazatomproms of the world, going into the spot market to grab some of those pounds that they need to be able to deliver into their contracts. So that's one thing. The second thing that's important with the legacy contracts is a lot of those contracts had provisions where the utility could flex up or flex down a certain percentage. So let's say you're a utility, you need 2 million pounds in 2024, but you're seeing the writing on the wall. Spot price is sitting at $106, $104, $106 right now. And you have an option in this contract to buy an extra, let's call it 500,000 pounds from Cameco or Kazatomprom at a price of $75 a pound. Well, that's a no-brainer. You're going to exercise that flex up option. Okay. Now that creates a problem. It puts pressure on either Kazatomprom or Cameco, who are stuck in this situation, because both companies in the past year, because in the past few years, drew down their inventories. So now if you've got a few or a bunch of your customers that are all flexing up at the same time, it wasn't a problem when you wrote the contracts 4, 5, 6 years ago, because there was lots of material available in your inventory on the secondary supply. But now there's hardly no material available on the secondary supply, and your clients are saying, yeah, I want more, and now you have to find these pounds. So we're sitting at a period in time here where that's very, very interesting. And it's not like 2021. I made a comment to that a little while ago. 2021, it was just split buying that was driving the price of uranium up, and then the equities followed. Now there's hardly no financial players playing. Since 2021, there's a lot of secondary supply that's been mopped up. Split has done a very good job of that. There's very, very little secondary supply now. And those that do have secondary supply, are seeing the prices going up, and they're saying, yeah, I got the stuff that you want. And when it's rising price, they're not as keen to let go of it, because they know they could sell it further down the road for a higher price. And the best example we have of that is the fact that the spot price has been sitting at $106. You could look at the bid and the ask, bid and the offer, and it's been sitting at $108 and $104 for almost a week. So the sellers it's a stare down. You want my stuff? Come and get it. So so the situation is 2024 is going to be great, because now the utilities who have waited and waited and waited for years, they've been told and told and told over and over and over again, this is going to happen. Their consultant UXC, who has normally been very, very conservative in making predictions, and basically for the past year has been blaring red signs here. There's no more secondary supply. You guys better get on the bandwagon. You better incentivize new supply. And then utilities are going to say, well, I'm not sure we believe that yet. Well, and so which brings us to the situation we're in now. And a lot of the American utilities have just been sitting on their hands waiting to sign contracts, and now they need to sign contracts. Basically, Kazatomprom and Cameco are almost sold out for the next few years anyways. And there's no real panic for this year or next year. In terms of nobody's going to run out of uranium this year or next year, but the uranium that's needed in the upcoming years, the next 5-10 years, that's really in question right now. And all of the models that were made by the experts with regards to how much uranium is going to be consumed in the upcoming 10 years per year for the next 10 years, and who's going to produce what, And all of these models, you could throw those out the window. And, how often have we seen, uh, you know, uh, big banks or analysts or whatever come out with reports and say, oh, I think the price of uranium is going to be $70 in October. You know what I mean?
Yeah.
Oh, and then rise in November. I think the price of uranium is going to be $75. Well, throw all of those numbers out the window now.
Well, we already
Basically,
have.
yeah, I know, yes. But what I mean is that for the future, throw all those predictions out.
Yeah.
And I myself, when people would, if people were interested, uh, would ask, what I thought and whatever. I always tried to be fairly conservative in terms of giving out price for spot uranium. Like I truly believe that we would see over $100, and I did think that we would at least achieve, the high of 2007, which was $140 a pound. And I thought that, we might go further than that, and then we'd come back down to some sort of price, maybe let's call it $80, $90 a pound. That's out the window now. Like that's it. I don't think that we're going to see below $100 a pound at all anymore. And now I'm fairly confident we're going to see over $200 a pound spot price. And the producers are sitting in the driver's seat right now. They've got the uranium that they have in the ground, and those mines and those mills are very, very, very valuable assets right now. And any smart CEO and CFO has seen, knows what's going on, and so they could basically call the shots on those contracts. And just to give you a little bit of an aside, I've been listening into Cameco conference calls for the past several years, and on some of them I've gone on and I've asked questions. And at one point, maybe 4 years ago, Cameco was always talking about, we'd be happy to sign a contract with a four handle. In other words, we'll sell our pounds in the 40s because Cameco at that point in time could produce it for $20, let's say. So they're making a healthy margin. And I got on the phone, and they said that for a year, 2 years straight. And one of the questions I asked them one time was like, listen, you guys have been saying this for 2 years. The situation's getting, more dire and dire for utilities now. Why are you still willing to sell your stuff for $40? And Tim Gitzel, I think it was Tim Gitzel that responded and said, well, you have to understand that our utilities, we've developed long relationships with them. And it's, you can't, it basically was saying you don't want to gouge them. You don't want to take advantage of them. You have to sell your stuff at a reasonable price and blah, blah, blah. And I think you could throw that out the window too now, because the utilities didn't care about those relationships when the chemicals and the different companies had to shut down production, and they didn't care. They were able to get their stuff for cheap.
Right. So
For many years, and they were told over and over and over again that this situation was going to present itself, and that they needed to start spending money to incentivize new production. And they laughed people that were saying that, they laughed them out of the room. So I think that those that do have production capacity, and the developers that are coming online in the next few years, they're going to have quite healthy margins. They're sitting in the driver's seat right now.
Yeah. Yeah. For a long time, it has been a one-way street. You mentioned the spot price, utilities having to buy from the spot market. Now, the term market hasn't really moved as high as the spot market. And if you recall, back in 2007, that was an indicator of a top there. So if you look at spot price versus the term price, you've got your spot price here in blue, you've got your term price here in gray. You'll notice that in 2007, you saw a massive deviation between the two, and that precipitated the blow off top in 2007. Today, now this chart hasn't been updated for the month of January yet. Still has a $91 uranium spot price, but nonetheless, the term price is well below that. So, what do you make of that? Do you think the term price is going to catch up to the spot price, or will the spot price continue to deviate away from the term price?
That's a good question. I think that we're going to see something similar. But the other thing that we have to keep in mind is that, the term price is always lagging the spot price because it's a very opaque market. It's what's reported. Sometimes it's when our RFP goes out, it's based on the RFP price or the lowest bid price, or so there's a lot of non-disclosure agreements involved here. But to me, I think that the term price now is going to follow the spot price. Is it that important? I don't think it's that important for investor sentiment, because investor sentiment seems to follow quite a bit more the spot price. But I mean, like, place yourself in the position of a Cameco or a Kazatomprom or a Denison Mines now that's going to be starting production, or any. Why would you be selling your stuff at $70 a pound now, when the price is going considerably higher?
Right. Typically, people point to this and say, "Oh, there's a top in sentiment, there's a top in retail." But I want to show you another chart. I don't know. I posted this on Twitter a week ago. I don't know if you saw it, but this is Google Trends data, and it goes back all the way to 2004, and it basically measures search query volume for the term uranium stocks. So that's kind of your indicator for retail sentiment.
Yeah.
Now, what you'll notice this big spike here in 2007.
Yeah.
The huge surge in uranium that we've seen today, we've barely gotten off the mat, as you can tell here. We're indexed about 21% relative to that spike in 2007.
Yeah.
And there's been, I actually looked this up. Internet user adoptions quadrupled since 2007 as well. So even if you say, oh, well, it's 21% of the 2007 highs, that's equivalent to quadruple that. So we've essentially, I'm very cautious to say that retail has come in yet, because it's just barely gotten started.
No, I don't think retail has come in yet.
Yeah.
I don't think the mainstream has come in yet, at all. Even in 2021, when we saw in October 2021, there's 2 or 3 spikes there. Those are still not even close to the spikes that occurred in 2007.
Yep.
With more people on the internet, more people in the markets in general. So I like, you've seen since December more snippets of people talking about uranium, on some of the business channels, and some of the banks have put out reports and stuff like that. But I mean, you listen to a Cameco conference call, like the analysts that the banks send there have, I'm sorry, but very little clue. They're always asking the same kinds of questions, like that aren't even relevant to what's going on in the sector. Anyways, so I think that I agree with the point I think you're trying to make, is that we haven't seen retail or large volume of investors in this sector yet. And I think, again, it's because of, like, show me the money kind of thing. It's always been like kind of 4 steps forward, 3 steps back. And, and there have been reasons why it was 4 steps forward and then, all the way back. But now I think we're at the point where there is no back. The spot price is going to remain high. I think that once we work through this chop from the rebalancing, I think that the Kazatomprom conference call on February 1st is going to give us more information on what's going on with their production issues. I think they have more issues than what they're letting on. They blamed it on sulfuric acid, but I think it's more than that. Other people have also spoken about that. Justin Hume has a very interesting viewpoint on that. So I think that Cameco now is even talking about starting up another mine because there's a demand. We need to meet that demand, and it's going to take a couple other very, very large mines to come on because the nuclear renaissance is here. Is better than it's ever been at a time when the supply of this stuff is more at risk than it's ever been. So listen, it's taken a long time. We've been those of us that have been in this thing for a while have been extremely patient, and we've had a lot more gray hair develop. But I think that like now, I don't I just someone on Twitter, and I think it was Yellowbull. I think it was Yellowbull or Nostradamus talked about the 2021 like run as a three-legged stool.
Mm.
And one of the legs fell out, which is true. But now, um, I mean, you've got Kazatomprom and Cameco, the worlds that control like the majority of the production of this commodity that are sold out, that probably sold more than what they could produce, and they need to be more active in the spot market, and they're very guarded. They never, Cameco on the conference calls, people try to find out, well, okay, how many pounds are you going to be buying? Like, oh, well, we need the 10 to 12 million pounds. We could get some pounds here, some pounds. They're very, very guarded with that information. And I don't blame them because, if people would front run the buying of uranium. But anyways, listen, the world's largest producers need to buy on the spot market. They sold more than they could produce. There isn't significant production that can come online in the next 3-4 years to meet that demand, even 5 years, that can meet that growing demand deficit. The price is going to keep going. The price is going to keep going up. And I think that this year and the coming years is when the equities are finally going to have their day in the sun.
Yeah. So I'm just, next question is just purely speculative, just for fun. Give me a base case in terms of where you think the uranium price tops out this bull run. Also, give me a wild case, like where do you think it can go as high to? And then kind of give me like a conservative case. So kind of like define the lower and upper bounds, so to speak. What do you think? I'm not going to hold you to these numbers, obviously, just for fun.
I one time I was doing an interview, and the interviewer asked. There was myself, Justin Hune, and Andrew Weekly were kind of talking about uranium, and the host, who was John Smith at the time, and it was for Follow the Money Investor Group, asked us to each give our prediction for the spot price at the end of the year. And I was way, way, way wrong. I had said $70 at that point in time, a pound. So that is very, very difficult. But I think that the price of uranium can double this year. I think that we could see price of uranium over $200 by the end of the year. And wild prediction, like the highest it's going to hit, I I'm I want to be conservative. I think we might see 250, 300. That's very difficult to say.
Yeah, yeah, yeah.
But
It's all speculation. No one
I'm
really
pretty
knows.
confident that we're going to go over 200.
Hmm. Yeah, that's what I've seen as well. Looking at the ratios, when you compare previous spikes to today's spikes, when you control for things like inflation, when you control for things for money supply, when you control for the gold price, when you control for, I don't know, the percent allocation to the market, to the S&P, it takes you. I mean, in my kind of analysis, you see something along the lines of $200 or $400, depending on which ratio you look at.
Yeah.
So yeah, that seems about fair. You mentioned the choppiness in the equities prices due to this rebalancing. Can you expand on that?
Yeah, sure. So URA, the one of the largest uranium ETFs, they rebalance. So they have to, they set certain percentages for their holdings. And for those interested, John Quakes did a very good tweet or post on that on X. I think it was yesterday or the day before, where he kind of did an estimation of, which names are going to be sold off, which names are going to be where the fund already has holdings of those names. They'll have to buy to increase to a certain. So they set certain percentages. So like, let's say Kazatomprom, for example, they'll say, well, we don't want that specific name, that holding, to exceed a certain percentage of our holdings. And what happens is, if that name, if the share price goes up, and so their market cap goes up, and then if it'll grow faster than some of the other names, then it might exceed that percentage threshold that they've set for that specific holding. So when they rebalance, then they want to sell off a certain amount of shares so that they can bring that percentage, the holding percentage of that name down to whatever they've set. And some of these other names, which are not, where it might be below the percentage that they want those names to be, then they'll buy more shares of that name or company to bring that percentage up. So that's what they're doing with the rebalancing right now. So, you've seen the bigger names in the past 2 months, let's say, go up in value more than some of the developers or some of the explorers. So it's those names will be sold off. Certain shares will be sold, and which could bring selling pressure on those names down. Could increase selling pressure on those names, and so which you could see the price of those shares go down because of that. And then, the smaller names where they'll be buyers of those shares, then you could see the price of those shares go up because of that buying that'll be occurring. And that's going to be completed. Usually they're done before, but they have until January 31st to complete these transactions. So this week you're going to see a lot of that. And again, in February, I think we're going to see another very good month, because the Kazatomprom conference call is going to bring more information on the supply issues that they're having, the production issues that they're having, which is, in my mind, could be good for the equities in the sector. And then a week later, on February 8th, you have Cameco. And usually the Cameco conference calls, the information that they provide is normally good for the sector, and usually the equities are green, especially in the past year or so. It wasn't always the case, but that's kind of been the trend, and I think that's what's going to occur again. So I think February is going to be another good month for the uranium equities.
Yeah. So you mentioned being in this trade for what, 2016, 2017. In what ways?
I did most of my research in 2016, and I started purchasing in 2017.
Yeah. So you've been in it for quite a while. You've seen how the seas change, how the game has changed throughout that course of time. How has your strategy changed, number one? And if so, how has it changed? In what ways have you pivoted?
Yeah, it did change, because when I started, well, just to make it clear, when I started, I actually did it with my children. So I wanted my kids to get involved into investing and understanding investing and stuff like that. So I started an investment club with my kids. And at that time, we each put in a certain amount of money, and we all bought, we just used the money, we bought Cameco shares into Cameco, which is the blue chip in the sector. And as time evolved, as I continued to do my research in the sector, as I became more comfortable in the sector, as I became more convinced of the thesis, then my strategy really changed. So I got information, and I've said this before, but there's a report out there that was put out by Sprott in January 2007, where they did a report on the sector, and they talked about their analysis of where they saw the price of uranium going, and they gave information on most of the uranium companies that existed at that time, or anyways, the companies that they followed, and they had producers and developers and explorers. And in January 2007, the price of uranium was $70 a pound. And they were saying in that report that they felt that the price of uranium could reach $100 a pound, and that was bullish for the sector. And then they were kind of recommending the uranium as an investment. And when I looked at those companies, I looked at the numbers that they gave, and those explorers, like you had explorers sitting at 300 million, 400 million, 600, 700, 800 million market caps. And I was looking, so as I was looking at my holdings, and I looked at some of these explorers, like there are some explorers there, like Baseload's a good example, was sitting at 5 million market cap. So I'm going, 5 million market cap. So when money starts to flow into this sector, it's going to lift all boats, because there's not a lot of boats in this sector. And like you and I have already talked about, when retail comes in, and just general comes into this space, a lot of money is going to flow in, I think. And so so I could maybe make a 5x, or I could make a 20x. Like I'm just so, and I kind of decided that if I modeled my portfolio where the majority of the money was into a basket of explorers, then even if they don't make a discovery, if money comes into the sector, then that should lift the boats up, and I should be able to see like a 3x, 4x, 5x, 10x, right? So I was kind of aiming for a home run here, and that's what I did. And then I also thought, well, if one of them can find a deposit, then that could be more than a 5x. It could be more than a 10x if it's a good deposit, sizable, if it's mineable, if it's blah 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 blah. And and if the other ones don't do well, that might offset my losses too. So that's how I model my portfolio. So about 80% of my portfolio. So I went to 80% of my portfolio into a basket of about 9 or 10 explorers. And then I have a few developers, and I have some past producers in that portfolio. And so that's how my portfolio was constructed. Now, this is very, very risky, obviously. I was speculating on, number one, uranium being the right, thesis. Number two, price of uranium going up. Number three, money coming into the so it's very, very, very speculative. But so far it's worked out very well for me, because a few of those explorers have done very, very well. Like, for example, one of my best performers is ISO Energy, where I started buying the share. I started looking at the share at 18 cents, and then it started going up, and then I said, no, it's going to go back down, but it didn't. And then finally I started buying those shares at 40 cents a share. So because I've been in for such a long time, but I think ISO Energy is going to keep doing well, because they still have a lot of very good properties, where and right now they're exploring again. So they started drilling, so they might make this is very speculative, but they could make another discovery. So that's how I model my portfolio. And after I adopted that strategy, what I did is I added to positions, and I trimmed positions as information on these companies became available. So, if a company went into like an exploration program, and I was really disappointed with the way they executed, or some of the information, then I trimmed my position. Some of them, I added to the position even though the price was going up. So I chased the price up because, I felt that there might be still a lot of room for the price of the share to go up if the drill results were positive. So since then, I've been adding and trimming to positions as information becomes available.
Yeah. So how do you see the time frame now? You've been in these equities for about since 2017. How where do you see the horizon at now in terms of this bull market?
Well, like if I'm correct in my assumption that the price of uranium is going to go higher, I think $150 now is like that's done. It's gonna
Uh-huh.
it's gonna reach that. So if it does, like let's say double in 2024, then I think that the equities, uranium equities, will catch up eventually because people will say, okay, this thing is real now. We've had a lot of false starts, let's say, and but now, like, the deal is in here. This is a true story. I need to start paying attention to this. So if the price continues to go up, then I think the equities will catch up at some point in time. We've also seen kind of a pattern where money, and this is the normal pattern where money will move into the bigger names like the ETFs, the blue chips, that kind of thing, and then into the developers. And I think that eventually money will flow into the explorers as well, because we need new deposits. McCarthy, Cameco, the both McArthur River and Cigar Lake, that, like, there's not unlimited uranium there. At some point in time, those mines will run out. We're seeing, we might be seeing some of that at Kazatomprom, where some of those early mines are starting to be depleted. They need more to spend more money, drill more, put more sulfuric acid in the ground to get more product. So, we need as a matter of fact, the CEO of Kazatomprom said it himself a couple of years ago. We need 2, 3, 4 more deposits like NextGen's Arrow deposit. So, I think that an exploration company that can hit a very a large, mineable deposit, that uranium is going to be extremely valuable in the ground. And just for comparison's sake, in the last bull market, companies that had deposits in the ground, where that were being bought out, the average buyout price was about $10 per pound in the ground. Well, you know, that $10 per pound in the ground, you could throw that number out the window too. So, if you look at a company like ISO Energy with their deposit that has 50 million pounds, if you could mine that deposit, um, at 2007 numbers, if that deposit gets bought out, well, that deposit would be worth 500 million. Well, we're not in 2007. We're in, 2024 now, and that number might be $50 a pound. 50, well, might not be 50, let's say it's $30 per pound in the ground. Well, then that deposit would be worth 1.5 billion. If you look at the market cap of ISO right now, it's not even close to that. So, that's a 3x from here. So, I think that there's still some room, first of all, just for the equities to catch up. And then second of all, if the general investor and this becomes mainstream, you could see some fireworks.
Yeah. So if let's do a little experiment. If if you had been in a coma for the last 7 years, let's say, and you had zero exposure to anything, including uranium, say you had like 100,000 or $1 million, would you still allocate 100% towards uranium? If so, like how would your portfolio allocation differ from what it is today? And if not, what else would you add on top of uranium?
That's a good question. I'm not sure. I'm really not sure because I still have not seen or heard a more compelling um, uh, investment thesis than what we're seeing in uranium now. Not like the thesis was good in 2016 when I got in, and I got convinced to put money in it. It's way better now. Way better now. Now we've seen movement in the equities. Like I said, like I was buying my first shares of ISO Energy at 40 cents, and they're sitting at what now? Like I didn't check this morning, but they're sitting at, I think there were $4 or $5. So, so I've made money already, but I still think there's money to be made in ISO Energy. I still think there's money to be made in other names that I'm holding. And like I said, I think that there could be, anyways, I don't want to make predictions, but you know, it would be different because if I woke up from a coma, I might not even be aware of the uranium thesis, and I might be looking at something else altogether. But I mean, if I had to do it over today, knowing what I know, um, back then today there's more vehicles that you could use to invest in. Like URNJ is a great example. Someone that doesn't want the wild and bumpy ride of buying into individual names. Well, URNJ is a great vehicle for uranium explorers and junior companies. If you want a little less risk and you want the bigger names, well then the Sprott Physical Uranium Miners Trust, URNM, is a great vehicle. Yellow Cake, if you believe that the price of uranium is going to double, well, you put your money in either Yellow Cake or Sprott Physical Uranium Trust. Another very interesting vehicle that I mentioned before is Uranium Royalty Corp. Some of these uranium companies, as they begin producing, they're going to be making, good margins. And Uranium Royalty Corp, their model is, they're going to help out some of the developers in their financing. They already own royalty streams, so they're going to be earning. It's the only royalty play in uranium sector, and in the gold and precious metals sector, there's a couple very successful royalty streaming companies there. So uranium royalty might be an interesting play as well. So I might be looking at stuff like that, but right now I'm very happy with my portfolio, and I'm expecting good things.
Yeah. Anything you're eyeing that you haven't really pounced on yet?
Uh, Not really. Not really. If I have, as more money becomes available, I'd probably just add to my existing
Mm-hmm.
positions.
Gotcha. Well, this has been a fascinating talk, Terry, as always. Go ahead and drop your socials and any closing statements.
Listen, thank you so much for having me on, and for your great work in covering, I know that you cover more than just the uranium sector, but your technical analysis and just trying to keep the information get out there, because um I've said it before. I've always, I feel like I know the number of the winning lottery ticket, and it's going to be pulled. That number is going to be pulled in the next little while. And before, I thought it was going to be 3 to 5 years, and we did make money, that's for sure. But I think it's going to be pulled sooner rather than later.
Yeah, I hope so too. Well, hey guys, did you give out your X handle, your Twitter handle?
You can if you want, sure. It's at Terry Papineau too.
Very good. All right, guys. If you enjoyed this video, be sure to like the video, subscribe to the channel if you haven't already, so we can get more guests like Terry on the show, and comment down below. Let me know what you think. Do you agree or disagree? I'll be sure to reply to almost every comment that I can get to. With that said, I will see you in the next episode. Bye, y'all.